Tell to carry on. So by placing a trailing stop in these types of locations, you're asking for serious trouble. So you see the price breaking. Let's assume you never get stopped out on that occasion. You see the price breaking and it comes down to there. Where are you going to put your stop? Where are you going to put your moving stop? Where are you going to put your trailing stop? Probably here, because you'll think to yourself, everybody that sells off that line, they're going to defend my stop. The price comes up to this line, goes through the line, and then obviously drives back off that line. So the two occasions you've put a trailing stop in place, you've been taken out to the tick on both occasions. To the tick on both occasions. How many times does that happen to people? How many times do they put a trailing stop just behind the wholesale price and it takes it out? Then you go, what the hell am I doing here? Great example. A great example actually on oil just in the last short while. There was a very, very nice opportunity to buy off a previous level that we've been buying from. It was the 109.50s. And, we got a very, very nice opportunity to buy down into a retested low. Never got the lower stops. And you can see the price breaks back above the top edge beautifully, right? So the price breaks back above the top edge beautifully. And you say to yourself, wow, look at this, guys. I'm in a brilliant buy trade at 108.60s. Looking fantastic, 160. Looking fantastic, right? And you say, right, I'm going to trail this. Where are you going to put a trailing stop? Probably just here, right? You're going to put a trailing stop just in there. What happens? The price comes down and stops you out to the tick at exactly the price you should have been adding in. You were getting taken out with some dumbass trailing stop, right? And obviously what happened is you've just seen the market going for a measure and you haven't been on board. What a disaster. Psychologically, that's like a massive blow, right? Psychologically, you look at that and say, oh my God, how bad can it get that I get taken out to the tick? Why are you keep getting taken out to the tick? Because you're putting in some really, really bad stop locations. That's why. There's sometimes as I said, you need to have a stop, absolutely. But where should you really put a stop? Well, there's a couple of things. The first thing, if I bought the bottom edge here, where should I put my stop on that trade? At break even. I probably shouldn't have my defensive stop anywhere else. Why? Because once I've made my first profit, so obviously when the trade goes, and I say to myself, right, I am now going to put my trade in, and I'm going to take some money out at this stage, right? So I'm going to say to myself, I'm going to take some money out at that stage. I'm looking good. I'm enjoying the trade. Where is my stop going to be? Well, my stop's going to be break even plus 1. So there's my stop right there. Break even plus 1. Now, why do I not bring the stop up? Because I want to manage my position, right? I might want to add in. I might want to take it out. I don't know what's going to happen. So why would I bring my stop up? It doesn't make any sense. Now, obviously, if I start recognizing that value is maybe dropping, why would I put my trailing stop away down here? If I think the value is starting to drop, if I was going to run a trailing stop, I'd probably be running the trailing stop up here. I'd probably run the trailing stop here, and then here, and then here, and then here, one candle behind maybe one candle behind the price. So that if I get taken out on my trailing stop, it's because I wanted to get taken out, but I wanted to let the price keep going as far as I possibly could. So I'd have got taken out there. And that meant that when the price ran the bottom edge stops by all the trailing stop guys that are behind the obvious levels, that's my buy trade, because all the people are getting stopped out here. I'm going to buy into their stops. And then I get this brilliant break to the upside. And again, the same thing happens. If I like the trade when I make my target price, so I make my first target price here, what am I going to do? Stops to break even plus 1. So even if I wanted to, guys, I could still go away, even if it's not plus 1, maybe it's plus 2, maybe it's plus 3, so long as it's below the POC of that balance area. Preferably down in the bottom quarter. Why the bottom quarter? Because if it goes through that stop there, it's probably going to make the lower lows. So there's no point in putting it at plus 1. You might as well put it plus 5 or 10 or whatever it is the bottom 25% is. So this is a great stop placement right here. Great stop placement. Because if you get stopped out, as I said, it'll go through the bottom edge anyway, most of the time. But it means that if the price bounces here, comes back a little bit, you're not going to get stopped out. And obviously, as the price starts to make its move, the obvious place to have a stop would then be here. That's where everybody's stops are going to be. So that's an obvious place to buy it. That's why the halfback trade does so well on so many buy trades or sell trades, because the halfback is where everybody's stops are going to be, because usually it's the change of behavior, right? It's got a change of behavior usually in the background. Now, if you think the market's starting to become bearish, or if you're getting closer to your target price, what do you do with a trailing stop? If you want to have a trailing stop, and you want to see how far the price goes, just trail it behind the last candle. Trail it behind the last candle so that you've got a volatility attachment to it. Volatility stop is obviously the size of the candle. When you then get stopped out here, you're not actually losing an awful lot of your trade. You're actually just losing a small part of the trade, and you've given it a fair chance to make full-size trades. Now, obviously, they'd already taken out target here, so you would obviously have been booking here, and perhaps you put a little trail stop in just to see if it was going to go all the way towards the top edge price. So getting stopped out here is just pretty good. When the price sells off and you're looking at it from the halfback pullback trade, and you're looking at it from the change of behavior level here, you start thinking to yourself, well, everybody's stops are going to be below this level. Everybody's stops are going to be below here. So the perfect trade would be to buy into there, but obviously on this occasion, it didn't quite reach that price, did it? So obviously it's up to you whether you're going to do a BSG squeeze, whether you're going to get involved in the squeeze trade here and start going after the top line sellers, because these guys have made no money, so they're going to be the weak sellers. And obviously the trade to the top side was absolutely exquisite. Right into that previous target price where we'd sold off all of this. Remember this balance area we talked about earlier? Same balance area, right? Price you all know about, surely to goodness. A price you all know about, a technical, incredible profit level right off of this level. And obviously the sell-off was brutally good. Where did the price stop? Well, isn't it interesting that obviously where's likely to be the buyer stops? Well, the buyer stops, the last change of behavior level was this price here. See it? So where do you think all the buyers that are still in this market stops are? So the buyer that came in at this price here and the buyers that came in at this price, where do you think their stops are? Do you think their stops are below here, or below this change of behavior? Which also included the 50 price, right? So it also included the 50 price wholesale. So where do you think the stops are likely to be, guys? All of these traders' stops are likely to be below here, correct? So where do you think the buy trade is likely to be? If there's going to be a buy trade, where do you think the buy trade is going to be? At exactly the same price as where the stops are, right? So we then recognize that there's a real money opportunity to buy if we wanted to buy. That's the question, if we want to buy. There's a real money opportunity to buy the stops. You must know where the stops are. Zeros and 50s, behind the zeros, behind the 50s. Behind the day highs, behind the day lows, behind the swing highs, behind the swing lows. The change of behavior levels, especially the change of behavior levels. Why? Because it's when a market's moved from a bull trend to a bear trend or vice versa. People who have came into a trending move. And you can start to look for those change of behavior level stops to make perfect trade executions. When we look at it from a value point of view, the challenge was, did we have any value to sell into this? Well, the answer to that question was yes. We had lots of value, didn't we? Look at the red line. We had lots of value to sell this, didn't we? We had lots of value to sell right there. When you look at the purple line is making a tested high at exactly the same time. The blue line's already massively discounted. The red line is nowhere near that price, and we get an activity surge. Activity surge. When we get that activity surge, what's that? That's a buy trade, right? So this is going to be your buy trade right here. The red candle right there. Guess where the red candle came in? The stops of the change of behavior, the stops of the RGLs in the background, these little puffs of activity in these areas here. Everybody's stops are going to be below here. Everybody. And that's exactly where the price goes to get everybody's stops at 101.40s for what turned out to be a $1,000 winner to the top side for 102.40s. See how making it obvious makes it dead obvious? Does that start to become recognizable as something that perhaps an awful lot of you might do? And if so, fix it. Simple as that, fix it. Either keep your stops further away or put your stops tighter. It's one or other. Don't sit somewhere in the middle of indecisive land, because that's where most trailing stops sit, isn't it? Right in the middle of indecision. Well, that's the worst place to put your stops. Think about it. Everybody says when you're putting a trailing stop, maybe move it a distance. Give yourself enough room. How much room? Well, 10 ticks. How much is the price likely to drop? 11. 11 ticks, right? If that's what the volatility is suggesting, 10 ticks is a good stop, the price will drop 11 ticks, 12 ticks, 13 ticks. If the volatility suggests doing a 25 tick stop, guess where the price will go to? 26, 27, 28 ticks. So you start to recognize that an ATR is a very, very useful thing in this respect, isn't it? Why is an ATR a useful thing to trade with in this respect? Why would that be the case? Anybody? Why would an ATR be a useful thing to know about? Because a lot of ATRs is what algorithms use for stops. Surprising enough, right? A lot of ATRs are where the stops are going to be positioned. And obviously, when you think about that, you think to yourself, wow, okay, that's exactly what I'm expecting. That's exactly what I would think. And this is why you start looking into those as stories, don't you? Start thinking about those types of stories, about where those ATRs are. So when you look at, I'll put one up so that you can see it, what I'm talking about, just so it makes sense, guys. Okay, so average true range here, and obviously if you're looking at it from a buy perspective, it's going to be above the, it's going to be, when we're looking for a buy trade, we're going to be looking for the price to break some stops somewhere. So there's a great example of that right here. Take a look at this ATR here. So you see this ATR here? Ran the stops there to become sell side, ran the stops here. Now, it's still got to be a sell trade. It's pointless if it's not a sell trade, right? So it ran the stops there to sell, and it's ran the stops there to become a sell. What happened here? Well, if you were long, the buy trade would be below that price, right? The buy trade would be below that price if you're long. If you're short, the sell will be above that price, correct? If you wanted to be short, the sell would be above that price on these pullbacks. Make sense? If you wanted to be short, the sell would be above that price there. So it's when the ATR changes direction, you already now know that that's where the stops will probably be located. So you're starting to recognize this volatility process. If you wanted to be long, you know there's going to be a lot of stops below here, but you can look in the background and you can see it's actually probably more likely to be below here. And if you wanted to be long, that's where your buy trade would come in. Now that's if you want to be long, remember. If you don't want to be long, then it's kind of it doesn't make any difference where they are. You just know that that's where a big sell is going to come in. So obviously that would be something if I was selling, for example, up here on this oil price, which we were, if I was selling here, I know there's going to be a big sell coming in here. So you could actually run the ATRs with buy side or sell side squeezes, couldn't you? That's a great place to run them because you know there's going to be imbalanced selling coming in here, assuming you're still bearish the marketplace. Assuming you're still bearish the marketplace. Do you see it? Do you understand it? Does it make sense? I think so. What else could you use? What else do people use? There's a little thing called the Donchian channel. You might use it, you might not use it. It doesn't make any difference whether you do, whether you don't, but it gives the previous highs and the previous lows, and it sticks the price to those levels. Great place to find stops. Fantastic place to find stops, especially if you're looking at it from maybe a bigger picture narrative to try and understand maybe the last 30 minutes of price activity. It just helps you to remind yourself as to where those stops are located. So you can obviously go backwards and you can look into it. You can try and figure out where the stops are likely to be, and you can try and figure out looking backwards. So if you're trading around about 30, you want to use about a 25 setting on it. And this is what it looks like. You've all seen it before, probably. You've all seen it before. So if I was bullish this market, where would I be a buyer? Well, you can see that it starts to find these kind of key levels here. See that key level there? So obviously, if I'm going to buy it, I'm going to buy it below that level. I'm going to buy it when it breaks that level, because there's going to be a lot of stops using that type of narrative. Now, it's obviously up to you to understand what we're looking at here. But you can see, for example, it's probably going to be up here. It's going to be a sell trade as it breaks that channel again. You're going to be able to see this idea, aren't you? You're going to always be able to see this, because the only way this can be selling is if sellers came in, and the only way this can be selling is if there's going to be a lot of stops coming from the price that's set off the selling. So you know if you want to sell it again, there's probably going to be a realistic excuse to sell it into this price area here. If you want to sell it again. It's a big if. You don't need any of this stuff, of course. This is just to show you some of the ideas. You simply have to draw the levels on the charts yourself. And what we're trying to do there is hunt for stops. It's a great exercise. We'll do it in classroom tonight. Just as an exercise, so that you're always focused in on where these stops are located, so that if you want to buy it, you know where you're going to buy it from. You're going to know where you're going to do the trade from.